Good evening. This is Doc Severson with a Theo Night Report for Tuesday, June 26th. We have about half an hour left to go in the cash market today, and what we're seeing is after yesterday's big gap down and big distribution day, we're seeing an inside day here with pretty much a high wave candle sitting on the S&P. Now, what is the problem right now with U.S. equity markets? The problem, this is the root issue right now, is uncertainty. There is so much uncertainty coming into the markets every single day that it literally cannot handle it. It cannot process the amount of risk that's coming in. Now, this didn't seem to be a problem last year, but it definitely is a problem this year at current prices and with rising interest rates. So look, what everybody wants to know at this point is whether the price is going to go higher or whether it's going to go lower into this summer. Well, honestly, I don't know the answer to that. However, what I can use is technical analysis to help develop a framework to help me understand what it's actually doing and then respond accordingly. I'm not really one to read up on the fundamentals and watch the news and try to forecast what's going on based on commonly available information. I believe that everything that we know today, right this second, is priced into the chart. It's priced to perfection right this very second. And if that equation changes, then the price chart will let us know. So what I'm going to do for the four major indices that we look at in the United States, so the S&P 500, we'll look at the Dow, we'll look at the Russell 2000, we'll also look at the Nasdaq, specifically the Nasdaq 100 futures. And we'll look at each one of those and determine what are the breakpoints that have got to be achieved for the market to retain an uptrend or whether they're already breaking into a downtrend. Now, looking at the S&P here, and actually I'm looking at the spiders, which is the ETF of the S&P 500. The reason why I like that is because not only does it show gaps better, but we've also got the weekly expected move outlined here. You can see the lower edge of the expected move. We can also see the higher edge of the expected move. So on day one, we pierced the bottom edge of the expected move, but the close held. The close is actually more important than the lower shadow here of this candlestick. Now, on a larger time perspective, the issue here, really the issue at hand, is this could be a lower high and a larger time frame chart. At this point, it's not totally clear as to whether that's the lower high in the weekly chart. That is certainly the case. I don't think this is a lower high in the monthly chart yet. I believe that we would have to see something much larger to create that lower high. But even if it's a lower high in the weekly chart, that is a significant signal, and that has lots of parallels to exactly what happened at the end of 2007, early 2008. Now, just because it's a parallel does not mean that it has to happen. So this is why we need to frame in the price action and understand what's happening and watch these levels, whether they hold or whether they fall. So again, there's two major rules that I have in price action. Number one is that larger time frames dominate the trend. And right now we still have an uptrend in place. After consolidation, we've released to the upside. However, that can change. Tops are a process. But rule number two that I have of price action is that reversals start from the inside out. So it will start from the smallest time frames and then start to propagate higher in time frame. So in other words, we've already started to move into a daily downtrend, which in this case is only a weekly swing down. That by itself is no big deal. But what happens if we print a lower high on the weekly chart? Then that is a big deal because that is a very strong reversal pattern. So here are the levels that we need to watch for. First of all, we have a very strong level down here at about 2680, 2682 or so on the full S&Ps. Let's zoom in here and show the parallel of that. That would be about this level here on the spider. So you can see where this last pullback, this last slingshot got started from is exactly the support level that has to hold. Right? So that level must hold for the bullish case to stay intact. Number two, what has to happen for the bullish case to stay intact is this gap has to be filled and then continue higher. So what we're going to find is that this gap may or may not be an attraction level for the S&P to come fill first. But if it does fill it, it's got to keep going past that 274-ish level into a higher high. Otherwise, this could go up to here, print a lower high, finish its job of filling the gap, and roll over again. Now let's assume that it doesn't even get there. If it doesn't even get up to fill that gap again, that's bearish. That supports the downside conclusion. Then what we have to watch for is whether or not this just goes straight into a lower low, which is going to be below this level. Again, if that level gets undercut, then what that does is that raises the probability that any move down here, like an undercut or maybe a test of the 200, is going to bounce up to a lower high. So again, if we print a lower low, then the probabilities improve that we're going to print a lower high and continue rolling over at this level. And what that does is also increases the bearish outcome from this, turning this into a major lower high. Now, as I said, at this point on the spiders, no harm, no foul. We still haven't printed the lower low yet. So if this turns into a slingshot move, we fill the gap, and then we continue higher from here. This is going to catch a lot of people on the wrong side right now because there are a lot of folks positioned bearishly at this point. And so the squeeze will continue. So again, the trend has not changed on the S&P daily, certainly not on the larger time frames yet. So my decision box is really around this area here. If we continue printing lower lows here, then the bearish case is much stronger. If we blow through that gap, then the bullish case begins to be much stronger. Now let's quickly move to the Dow. We have a much different picture with the Dow. The Dow has already printed from a higher high to a lower low. So this is the example, the same thing as the S&P I was talking about a minute ago, that if we print that lower low, it increases the probability of a lower high setting up. That's already happened on the Dow. The Dow has a much lower probability of making a higher high from here. It has a much higher probability of making a lower high from here. So this is the most likely outcome at this point, is the Dow at some point, whenever and however it rallies, will rally into a lower high, will get everybody leaning in the bullish direction, and then the trapdoor opens once again. Right now, the Dow is in real trouble, as I indicated in my report last week. Here is the Russell 2000. The Russell 2000 right now is basically giving the Alfred E. Newman version of what me worry, because it's pulled down into a pullback, but we're already seeing a fairly strong rebound off that pullback so far. There's no lower high here yet. The reversal process has not started yet on the Russell. So the Russell is being very much aloof in terms of the uncertainty when it comes to tariffs in international trade. And this is why we're seeing so much accumulation in the Russell right now. However, there's limits to everything. Right now we have a weekly chart in exhaustion. This is unlikely to continue screaming higher. At best, the Russell is going to be range bound in the near term up in this area. The fact is that the Russell is being viewed as a safe harbor right now, believe it or not. And then we'll finish out here with looking at the Nasdaq. I like to look at the Nasdaq futures in this case, and we're seeing somewhat similar picture to the Russell 2000. A little bit more weakness here. We've had definitely a little bit of distribution when it comes to some of the larger cap techs. Those that we call the monsters of tech have certainly come under distribution lately. But again, there's no change in trend yet. This has come down to a very important pivot level at this point. That pivot level is right around 7,000. So far, that has held. This is what we have to see for the Nasdaq. So what we're going to have to see is whether or not it's able to bounce at this level and continue into highs, new highs, or is this going to just bounce up a little bit and then print a lower low after a lower high. So again, as we look at all four of these, definitely the Dow is in the worst shape of all. The S&P is next. The S&P is very shaky right now. Could go either way. And again, on the other side of the ledger, when we look at the Nasdaq and we look at the Russell, those are still fairly strong right now. There's a lot of work to do before these are going to start to go into distribution mode. Remember, tops are a process, and they have to start from the smallest time frames and then eventually propagate over to the larger time frames before they too put in downtrends. We don't just see stocks sell straight down from the top, even though that's part of urban legend. We can just see this if we look at the monthly chart. Bottoms are an event. Tops are a process. Tops take a long time to print before they, in a very torturous fashion, start to fall down. This top here that started in 2007 took until the summer of 2008 before that monthly lower high printed, and then the real selling begins. So I'll go back to the very first thing that I said at the beginning of this. What this market craves right now is certainty. If certainty does come into the market in the next week or two here, then we'll more than likely see some type of rally up. Now, whether that prints a lower high or not, we'll have to see. If the market continues to get no certainty, we will continue to sell lower until a lower support level is found. That by itself could put it back into the correction range again. That's it for today's report. Thanks for listening, folks. We'll see you tomorrow.